Something historic just happened in global finance, and almost nobody is talking about it the way they should be. While most investors are staring at stock charts, inflation prints, and Fed speeches, a much bigger move is unfolding quietly in the background. A move so large, so deliberate, that once you see it clearly, you can't unsee it. China is walking away from U.S. debt, and they are doing it at a loss. Not a small loss, a strategic loss. And that should immediately make you uncomfortable. Before we go any further, if you want calm, no-hype breakdowns of the financial shifts that actually shape your future, make sure you subscribe to Capital Pressure right now. This channel exists to connect the dots Wall Street doesn't want connected. Hit subscribe, turn on notifications, because what we're covering today isn't theory, it's positioning, and it directly affects your money. U.S. Treasury bonds are supposed to be boring, slow, heavy. They're the backbone of the global financial system. You don't just dump them overnight without consequences. It usually takes months, sometimes years, to quietly reduce a large position without blowing up the market. That's why what we're seeing right now defies normal economic behavior. According to the latest data from the U.S. Treasury's TIC report, China's official holdings of U.S. government debt have fallen to roughly $688 billion. That number might sound large if you don't know the history, but in context, it's a collapse. This is the lowest level of Chinese ownership since 2009. 16 years of financial integration erased. At the peak of the U.S. and China economic relationship back in 2013, China held over $1.3 trillion in U.S. debt. They weren't just an investor, they were a pillar. China recycled its massive trade surplus back into U.S. bonds, helping fund American deficits while keeping interest rates low. Americans bought cheap goods. China accumulated paper assets. The system worked because both sides believed it was stable. That belief is gone. China has liquidated nearly half of its peak position, more than $600 billion sold. But the most important detail isn't how much they sold, it's when they sold it. Throughout 2024 and 2025, the U.S. bond market was in one of the worst drawdowns in modern history. Interest rates surged, bond prices fell hard. Anyone selling during this period wasn't rebalancing, they were locking in losses. In asset management, you do not sell a depreciated asset at a loss unless one of two things is true. Either you desperately need cash, or you believe the asset itself has become dangerous. China does not have a cash problem. Despite internal challenges, they continue to run trade surpluses. They have reserves. They have liquidity. So if it's not desperation, what's left? The only conclusion that fits the data is this. Beijing no longer views U.S. Treasuries as a safe store of value. They see them as a strategic liability. To understand why, you have to go back to February 2022. When Russia invaded Ukraine, the U.S. and Europe froze roughly $300 billion of Russian central bank reserves. These weren't risky assets. They were sovereign reserves held in Western financial institutions. And with a few keystrokes, they became unusable. That moment sent a shockwave through Beijing. Because China realized something critical. If a geopolitical conflict escalates over Taiwan, the South China Sea, or anything else, U.S. Treasuries held by China are not protected assets. They are hostages. The moment sanctions are applied, those bonds become frozen paper. So China is choosing to take a controlled loss today rather than risk a total loss tomorrow. A 10 or 20% haircut now is better than a 100% write-off later. This isn't panic selling, it's a strategic exit. And the speed of that exit matters. Nearly $12 billion sold in a single month recently. Central banks usually move quietly to avoid market disruption, but this pace signals urgency. China wants capital out of U.S. jurisdiction, and they want it out now. This creates a massive problem for the United States. For decades, America could run enormous deficits because there was always a price-insensitive buyer overseas. China bought regardless of yield. That buyer is gone. And when the second largest holder of your debt becomes a seller, basic economics says yields should spike and prices should collapse. But that hasn't fully happened yet. Why? Because someone else is stepping in. When you look deeper into the TIC data, something strange appears. As China's holdings fall, the United Kingdom and Belgium suddenly surge to record levels. The UK now holds over $750 billion in US debt, nearly matching China, despite having a much smaller economy and a trade deficit. Ask yourself a simple question. Where is Britain getting that money? They aren't running massive surpluses. They aren't swimming in excess capital. The answer is leverage and financial engineering. London is acting as a shock absorber for the US Treasury market. Belgium tells a similar story. Its reported holdings are massive, but Belgium itself isn't the buyer. Euroclear is located there, a global custodial hub. When you see Belgium spike in the data, it often means other entities are parking assets through it for anonymity. Put it together, and the picture becomes clear. As China exits, U.S. allies are being pressured to step in. This is not a free market, it's financial conscription. Washington cannot allow the Treasury market to break. So the burden is shifted onto allies, even if it weakens their own balance sheets. Liquidity is being drained from Europe to support American debt. This strategy has a fatal flaw: capacity. China had unlimited capacity because it produced real goods and earned real dollars. The UK and Europe do not. They already carry heavy debt loads, slow growth, and fragile currencies. If their economies stumble, they won't be able to keep buying. And when they stop, there is no natural buyer left. China knows this. That's why this is a war of attrition. Every bond China sells forces the West to find a buyer. Every dollar absorbed by allies is a dollar not invested in infrastructure, industry, or growth. Capital is being funneled into a black hole just to keep the system standing. And while the West shuffles paper claims, China is doing something far more important. They're converting paper into physical reality. When China sells a treasury, they receive dollars, but they don't want dollars. Dollars are traceable, sanctionable, inflatable. So they are moving those proceeds into assets the US cannot freeze: gold, energy, industrial metals, food. China has been buying gold relentlessly. Official numbers already show continuous accumulation, but physical withdrawals suggest even more. Gold has no counterparty risk. It cannot be frozen. It is the anti-dollar. They are also stockpiling oil. China imports most of its energy and understands its vulnerability. Strategic reserves are being filled to the brim. Satellite imagery confirms massive new storage facilities. This is preparation, not speculation. Copper imports remain near record highs, despite a depressed property sector. Why? Because copper is essential for power grids, weapon systems, vehicles, and industrial capacity. China is hoarding the inputs of modern warfare, and food. China now controls a staggering share of global grain reserves. Calories are security. You can't sanction wheat. This is the mindset shift that matters. A nation planning peace maximizes financial returns. A nation preparing for conflict prioritizes survival. China is willingly accepting negative financial yield to secure real-world resilience. Western analysts mock the losses, but Beijing isn't thinking in quarterly returns. They're thinking in decades. So what does this mean for you? It means the US Treasury bond is no longer a neutral asset. It's a political instrument. The old 60-40 portfolio logic was built on the assumption that bonds were stable. That era is ending. If the largest manufacturing power in the world is exiting, you should ask why you're still holding long-duration debt. Short-term instruments behave like cash. Long-term bonds are exposed to geopolitical dumping and rising supply. Duration is risk. Hard assets matter again. Commodities matter again. Real producers matter again. And the final warning signal to watch is the allies themselves. Watch the British pound. Watch the Japanese yen. If those currencies break, their ability to support the US bond market disappears. At that point, the Federal Reserve becomes the buyer of last resort. And when that happens, money printing fills the gap. That's when inflation reasserts itself. China sees this clearly. That's why they're moving first. If this breakdown helped you understand the shift that's happening beneath the surface, share this video. Comment your thoughts. Debate it. Engagement matters because these conversations are being actively avoided elsewhere. Subscribe to Capital Pressure if you want clarity instead of comfort. The system is changing. The exit has already started. We're just waiting for the adjustment. Stay sharp.